weather model continues to support, Goldilocks type pricing from a market signaling standpoint. So we use our record weather model to determine how long the current top-down market regime is likely to persist, or at least with respect to the rolling 3-month forward forecast horizon that this model generates. If you want to know about the 3 months after that, well, let's wait 3 months and then ask me what the weather model was signaling 3 months at that point in time. This is not a tool that's designed to tell you the stock market's going to peak next June, or the stock market's going to peak, or have a crash next August. That's not what this tool is designed to do. This tool is designed to help you constantly stay on the right side of market risk by analyzing and ultimately regime segmenting the principal components of macro in a way that creates a really strong signal from an excess return perspective for each of these asset classes. So as I mentioned, we'll get into the 10 principal components of macro in a second here, but I don't want to bury the lead in the sense that, the reason we think the Goldilocks top-down market regime has a, fighter's chance of persisting over the next 3 months is because the 3-month outlook for stocks is bullish. The 3-month outlook for the bond market is bullish. The 3-month outlook for Bitcoin is bullish. The 3-month outlook for commodities is neutral, and the 3-month outlook for the dollar is bearish. This is Goldilocks. When you're talking about market pricing of Goldilocks, that is Goldilocks. The 3-month outlook is effectively saying Goldilocks. We are currently in Goldilocks from a grid regime perspective. That's because growth is accelerating and inflation is decelerating, and it's a medium conviction Goldilocks because at least one of the next 12-month deltas from a consensus growth and inflation projection perspective is confirming that. So you're getting a confirmation from inflation. You're not getting confirmation from growth, and so that's why it's only a medium conviction. To be a high conviction if they're both giving you confirmation. So kind of the key conclusion in terms of relating this back to our current nowcasting of the top-down market regime, the market is telling you we're in Goldilocks. The weather model, the 10 principal components of macro, are telling you we're probably going to be in Goldilocks type market conditions on a rolling 3-month forward time horizon basis. And when that change, we'll signal in real time. We just don't live in fear of that change because, again, what our models are proving in real time and have been all year is that you can be reactive to the change in the signal because the models are forward looking. The one thing if the models are backward looking, and you have to live in perpetual fear of being, of a change in signal, because it means you'll be too late to respond in your portfolio. But the reality is you're not going to be too late to respond in your portfolio. These models are forward looking and designed appropriately to help produce superior results. So let's get back into the 10 principal components of macro. We'll start with the real economy cycles. As I mentioned, we did growth and inflation already. Unemployment rates trending higher, is expected to continue trending higher. S&P 500 implied sales growth rate is trending lower. The implied earnings growth rate is trending higher. Sovereign fiscal balance as a percent of nominal GDP is trending lower. These budget deficits are massive. These were just all-time record non-war, non-recession budget deficits in the U.S. economy. So that fiscal impulse continues to support growth and inflation at the margins. But certainly right now, inflation is not supporting inflation the way that it's supporting growth. The U.S. dollar real effective exchange rate is trending higher, although it looks like it's finally peaking and could be headed on a lower trend later. And that's obviously something that would this arrow inflicting to the negative would obviously incrementally support the Goldilocks type projection that you're seeing in the middle of the page. In terms of the financial economy cycles, net liquidity is trending higher. 42 macro net liquidity is trending higher. That's the Fed balance sheet total assets minus the TGA and the RRP balances. 42 macro global liquidity proxy, that's a global central bank balance sheet plus global broad money supply and global FX reserves minus gold. Those are both trending higher. These are something that that popped in real time when the macro weather model pivot, turned stocks to bullish, turned bonds to bullish, turned Bitcoin to bullish 5 weeks ago. It's because the global liquidity proxy inflected higher. In fact, the 42 macro net liquidity inflected higher in late October when the KISS model started buying Bitcoin. It was it came alongside, it wasn't driven by, but it came alongside this an inflection on that liquidity model. So our models picked up, this positive impulse in liquidity in real time. And quite partially, one of the reasons we built the weather model going back to the beginning of this year was because we missed that big wave of liquidity that we saw in Q4 of 2024 into 2021. And that obviously cost us a lot of performance on the short side of assets in that period of time. And so, that's when we made a conscientious choice as investors to, pivot from a discretionary oriented process to a systematic investment process, i.e., introducing KISS in January of that year. We stopped shorting altogether because we think, we are going to be better in terms of delivering results for at least for our retail and RIA clients in terms of just focusing on left tail risk and helping them mitigate left tail risk while kind of building tools and models and systems that allow them to take advantage of that right tail risk and actually be invested when it's time to be invested in markets. So that we made some big important process changes this year that have really helped us throughout the year. Kind of create some really positive outcomes for our subscribers, and I'm very proud of that. And so if you hear me harping on this stuff, don't gloss over it. These are some of the most powerful tools that I see out there in financial markets in terms of helping investors navigate these macro cycles. So in terms of credit, trending lower both domestically and globally. Credit growth, interest rates are still trending higher in terms of the policy rate. We're trending lower in terms of what the short rates are pricing in relative to the policy rate. Aggregated U.S. dollar positioning is neutral. Aggregated treasuries positioning is bearish. Aggregated commodities position is bearish, and aggregated equities positioning is neutral. In terms of so these weather model signals, as mentioned, for the stock market is bullish. Weather model signal for the bond market is bullish. You can review the back test on your own time. Solid. The weather model signal for the dollar is bearish. Weather model signal for commodities is neutral. Weather model signal for Bitcoin is bullish.